All right. Good morning, good afternoon, everyone, and welcome to today's webinar. So today is actually an interesting day because it's the first time that we present the Kapture brand. I'm going to talk a little bit about it in a second. And secondly, I believe it's one of the most interesting investment opportunities that we currently have, which is CLO or collateralized loan obligations via funds that we newly created. It's now live. And I have the great pleasure to host this webinar together with Jean Marc Spitalier. Spitalier, internally, we call him Mr. CLO. He has a very strong, long experience in CLOs and structured credit in various institutions. So we are very happy to have Jean Marc on board with us in Kapture to co-manage this CLO, the CLO fund. We will go a bit more in details later on what the CLO is and why we believe it's so interesting. But let me quickly introduce you to Kapture, which is a new venture that we recently created. In a way, it's a joint venture between partners of Catch and Horizon Capital. Together, we have about 3 billion in assets under management and 90 employees. Within the Kapture brand, we currently have 4 different investment strategies. So we have litigation, real estate lending, and now also the CLO fund, which is something new. As I said, we just created it. It's Luxembourg-based. I'm going to talk a little bit more in details about the fund later on. And the target return of the fund is 10%. So that's very important to know. Net return target is 10%. And we have weekly liquidity. So this makes it a product that is a bit different compared to other products that we have been presenting in the past, more on the liquid side, and a fund that is, of course, extremely diversified as well. The 4 partners, together with Jean Marc, we have Stéphane Prigent, Pascal Rohner, myself, and Laurent from Catch, and Sébastien Max from Horizon, that we own this venture. The Kapture investment philosophy is a bit of a continuity of what we also have in other investment funds. We really look at, I'd say, niche areas or underexplored areas that have a superior risk-reward profile. Here in CLOs, we're going to talk a little bit about it. So we look at the mezzanine tranches in CLO, where, of course, a lot of institutional investors don't really invest a lot because they need too much capital requirement for that. We're going to go a bit more in details about that. So there is really a niche as well that leads to superior risk-adjusted return, which partially can also be explained by complexity, which is an area that we always have been focusing on. Other than that, we also look at ESG criteria, which is in common with other Kapture and Catch funds. And of course, we look at strategies to mitigate risk and capital preservation. To this fund, I will now give it over to Jean Marc, but just very short, as I said at the beginning, net target return is 10%. We look at CLOs, mainly European CLOs, but also US CLOs. Jean Marc is going to explain to you. And as I said, the fund is based in Luxembourg with a weekly liquidity and five-day notice. With this, I give it over to Jean Marc to give us a bit more insights into the CLO market and how we structured the fund.
Hi everyone. I'm very excited to be able to talk about my favorite topic, which is our CLOs today. So most of what I do today is focusing on CLOs. It's an amazing structure. I've been a structurer all my life across different banks, BNP, Lehman Brothers, and UniCredit. And I've seen so many different structures. And I think the CLO is the most interesting one. And I will explain you why in a second. First, I think I want to say that the fund we have created is we want it to be an all-weather fund, so a fund which performs in any market. For that, we have decided to focus only on CLO. You know, in the world of securitization or ABS, you have many other fields like credit cards, auto loans, real estate loans, etc., mortgages. But we thought the CLO market is the most interesting. It's the largest market in EBS, and it's more normalized. Today, you have something called CLO 2.0, which define what is a CLO and has a lot of constraint in terms of diversification, in terms of leverage, in terms of rating, and we feel very secure in the environment of CLOs. That's why it's 100% CLO play, nothing else. But we have opened to two markets, the US and Europe. Europe because it's the safest market, I will explain why later, and the US because it's the most liquid market. So I think we have a combination of the two, which enable us to, for example, when you have times where the primary market is closed because, let's say, there was an event in the market, like for example, the war in Ukraine has stopped issuance of new CLOs for 2 or 3 months. But in the US, they were still issuing. So also the US market is something like 7-8 times bigger than the European market. So it's important to be able to tap both markets because you don't know what will be tomorrow, and it gives an extra flexibility. I would say the target probably to be 70% Europe, 30% the US. Also, the relative value between the two markets varies over time. So sometimes you get better yield for the same rating in one market or the other. So the ability to play between the two markets is very important, not only for the liquidity, but for the performance. So what is interesting in CLOs is that your collateral are loans, corporate loans, or pretty large companies, and the loans themselves are secured sometimes, most of the time, by assets, and so it reduces the profile risk of the fund. Now the CLO market, we'll see later on, but its main characteristic is that it's floating rate bonds. You will see in 2022, the impact of being floating rates is huge. I think we can say about something like 20% of performance versus fixed income instrument. So it is very good to be resilient in period of high inflation because floating rates will adjust. Lastly, the structuring expertise. So I've been a structurer all my life, so I'm happy to spend time reading docs and offering circulars. It takes time, but it has to be done. And also in the CLO selection, you make two kinds of selection. One, you select a structure, so you have to understand the structure and the risk and the merits, but also you select a manager. This is what is very different from many other asset classes, is that one CLO, it's a bond, but a bond where the collateral is managed by an external party. And so you have to carry due diligence on this external party. And that was half of my career because I was actually responsible for fund derivatives at different institutions. And I had to do due diligence on many, many hedge funds. And that's today is very useful to me because when I talk to a manager, I know exactly what to ask them. And I know the due diligence has to be very qualitative, not only quantitative. And I know that you have to follow up. So it's a continuous process. And that's exactly what is Kapture. It's both a fund where we're going to be rigorous in the selection of instruments, but where we're going to be also applying a very strict due diligence approach to the managers. So I think, having said that, I think we can move to the CLO structure. I tried to explain you. I think we can move 2 slides. No, sorry. What we can say on this one. No, come back one, yeah. So I think what I said before is that we're financing very large companies, EBITDA above 250 million. As a manager, I'm comfortable with. You generally have 500 million average EBITDA, which is pretty large. These are companies like Ineos, for example, is the largest chemical company in Europe, or Virgin Media, or they're usually pharmaceutical companies, telcos, so telecommunication companies. They are technology industrial companies, and also the rest is pretty spread over different sectors. So it's very, very diversified. What is a CLO? No, we can say on this one. Yeah, this one. So CLO is not different from private credit. I think everybody has heard of private credit and the merits of private credit, but you take a loan which is private and you make it liquid. That's the effect of securitization. 57% of the loans are bought by CLOs. So just to tell you, the loans and the CLOs are exactly the same thing. So when you're buying a CLO, you're buying a package of loans, in fact. So you're in the loan market. So you have the merits of the loan market. Again, it is structured, it is protected, it is large companies. Secondly, it's floating rates. That's very important. It's rated. All the loans are rated. All the CLOs are rated. So you are in a universe extremely controlled. and very diversified. To give you an idea, one CLO is between 100 and 120 names, 20 issuers. So it's very, very diversified, and it's very transparent. Each CLO has a trustee which produces reports every quarter, every month, sorry, and you have a report of the CLO where you can see exactly what the CLO owns, what is the rating of each of the borrowers, what is the history of its borrowers, who is in trouble, who is triple C, etc., downgrades, watch list, etc. So, and for that, of course, you need a system. You have two large systems which aggregate all the information at the level below the CLO. So, and of course, we're using one of the systems called Moody's Analytics. Very important to go through on a look-through basis and know what's inside each CLO. I think we can move 2 slides ahead to explain what is a CLO. I think I like this chart because it's simple. If I wanted to explain very quickly what is a CLO, I would say it's a fund buying loans. So you see the asset side on the left are loans, typically 100 names, with a manager. So it's a fund of loan managed dynamically by credit loan managers. These managers are usually very well known. So they can be KKR, Carlyle, these kind of very well-known private equity firms. They can be banks like BNP, Rothschild, etc. Or they can be hedge funds like Sandpoint. And usually they are specialized credit shops. Very often they are multi-credit. They touch all the range of credit from investment grade to high yield to distressed. And they are very specialized players who actually know very well how to select loans. So that's very important. So this is the asset side. So it's like a fund having loans. And the fund, the only thing the structure does every quarter is passing interest in the order of priority of rating. So you bought shares in this fund, but it's not a fund, it's a CLO. But you could buy the AAA or you can buy the single B, right? You can see the AAA is paid first, then the AA, etc. Then the triple B, then the double B, then the single B. Once you paid, this is all the debt. So these are 2 buckets. So I would say the high grade and the mezzanine. Once you paid all the debt holders, what is left goes to the subordinated investors, or it's called also the equity of the CLO. Those people are people who want leverage. They are very important because this is not what we are buying. We're buying only the debt part of the CLO. But those people who want to get leverage and targeting 20% type of returns are the one protecting the structure, because the subordinated investor will protect the single B will protect the double B, etc. You can see that the coupons goes in the order of vertical, so from AAA to single B. But if we have defaults, it will go the other way around. The subordinated investors, which represent roughly 8-9% of the structure, will be the first one to bear the losses, and then the single B, the double B, etc. So very important. It's when you are in the mezzanine, you actually partially capital protected because the first default are not for you. And also, what is important is that structure will never deactivate. It always will pay every quarter what is available as coupon. So if one quarter is not enough coupon to pay the single B, for example, this coupon is memorized, and the next quarter, let's say there's enough money, or 2 quarters later, there's enough money to pay the single B, then the single B gets its coupon for the quarter and for the previous quarter. So it's very resilient in terms of, and so there's no, it's the opposite of a CDO, and you all heard about the CDO, of course, which has created the great financial crisis. CDO can deactivate based on market value. So if the loan price or the bond price goes down to a certain point, they start selling the bonds to repay the AAA. That will never happen in a CLO. CLO is a very parent structure which will never deactivate. The only thing it does, pays the coupon when they are available. They are not available, we skip to the next quarter. So that's very important. The second difference with CDO is that your collateral is going to be only corporate loans, nothing else. In CDO, D for debt, you can put any kind of debt, and in a CLO, like loans, you can only put corporate loans. That's a very important difference with a CDO, and it's a major one because, as you know, the CDO bankrupt was due to the fact that the underlying instruments were actually not valid. You had actually it was not only real estate loans, but it was subprime loans from people who cannot repay. So when you put a bad underlying in a bad structure, That's a catastrophe. The CLO existed in 2008, 2009. We survived the great financial crisis. There has been not a single default of a CLO bond since then, since 2008. That's important to mention, but you never see that in any credit market, that you have zero default. But it is a case that the CLO 2.0, being structured so efficiently, have crossed many crises without any default at the CLO bond level. Doesn't mean that you don't have default at the loan level, but again, because you're not first loss, you are actually second, third, and fourth loss in the mezzanine. You are protected for a certain level of default. And I think that's going to be the slide before we're going to play now to see what is the risk of default. Because once we explain the structure, we understand that you are protected, but up to what level are you protected? And so you understand that you are protected against one default, of course. You will never know if there's a default in a CLO because it has no impact on the debt. But the question is how many defaults you need to be in trouble. And here we have to look at historical statistics. And since more or less CLO existed, it started at the beginning of the century, you see that the worst case scenario has been in 2008, or actually 2009 and 2012. 2012 was, of course, the sovereign crisis, and 2009 the result of the great financial crisis. You see default level have reached roughly 8-9%. Depends on indices. Some indices will show you 12%, but the one I chose, the Credit Suisse loan index, which is the one longest standing, have shown this kind of level. But doesn't matter, because what matters is not the level of default, is the level of losses. As you know, when you have a default, you have a recovery. So what's important is what is left after recovery. And you see in both of these scenarios, you had roughly 5% losses, right? And you see the attachment point of the most risky tranche of debt, which is a single B, at the time was around 9%. So you see you're almost 2 times protected, even in the single B, which is not the most of what we buy. The most of what we buy is a double B. The double B was almost 3 times protected, and the 2.5 times protected, and the triple B more than 3 times protected. So you see, compared to the worst case scenario, this tranche of debt have a very large cushion. So statistically, CLO are very robust. So the only issue with CLOs versus default is that if you have more defaults, of course, the price of the CLO will go down because people will be scared and they will tend to sell their loans, their bonds. And so that's what has happened during 2020 and 2022. You have seen reasonably drawdown based on the value of these loans, but no default, right? This structure is super robust, so you have to accept a certain level of mark to market, but it's of course less volatile, much less volatile than equities, probably half the volatility of equities, and it compares with high yield in terms of volatility. So these are the statistics. They are extremely good, and I think that's what you have to retain about CLOs, is that you don't have a single specific idiosyncratic risk on default. You have a systematic risk. You're facing a systematic risk, but historically you are protected 2 to 3 times compared to the worst case scenario. In average, default rate are 2%. So you see that the single B, even the single B is very well protected. I think we can move on. So when I said in 2022, you were protected against inflation, you see the loan index in the middle, ELI, European Loan Index, at the time had lost 3.4% over the calendar year. You see the CLO liability index roughly flat at 0.2. CLO liability are actually what we buy, so bonds or CLO bonds. And you see the rest of the market have actually suffered quite a lot. So it shows the resilience of a floating rates instrument, because the coupons have been adjusted. Euribor moved from 0 to 4%. So suddenly you receive 4% more coupons. And then because it's floating rate, of course, there's no sensitivity to interest rates. So the duration is close to 0, is 0.25. So the only sensitivity you have with CLOs is sensitivity to spread. Spread have widened, hence the LE index has gone down 3%. That was not the end of the world. And you see how you were protected compared to the rest of the bond market. Investment grade have lost 18%, for example. High yield have lost 11.5%. So that shows the resilience of CLOs in a period of high inflation. We can skip, I think, to the next slide. So now we are going to compare European CLOs with US CLOs. You can see there's not a major difference now. I think the level default are close, but you have seen that in 2020, for example, the level of default have accelerated in the US much more than in Europe. So that just shows that US market is more reactive to default because default is not an issue in the US. In Europe, very difficult to make default in Europe if you're a large company with a lot of employment at stake. And you see how it is more resilient. It's not so different today, but still over the big crisis, European CLOs are more resilient. That's why we focus more on European CLOs. One big difference also is that the European market is more focused on less cyclical industries like pharma, telco, and technology. In the US, you can have the energy sector, for example. Also, in the US, you can have some CLOs focusing on middle market, so mid-cap companies. In Europe, it's purely large caps, hence our preference for European CLOs. But again, because of the liquidity of US CLOs, it's good to have them also in the fund when we need them. And then for dollar-denominated investors, you have to account for today. That's interesting factor is that the differential between euro and US rates have widened to 2%. So when you do a systematic hedging, which we'll do, the dollar share class will be hedged into dollar, you will gain roughly 2% versus the euro share class. So that's something interesting to know, but you have to be a US dollar-denominated investor to benefit from that. So I think, this diversification effect also, of course, buying, if I have 100% of my fund into European CLOs, if I had 10, 20, or 30% of US CLOs, I'm adding new names that I don't have. So I'm reducing my specific risk to one issuer. We can move on. So this is almost a conclusion slide, I would say, because it has it all. If you have one slide to remember, is this one. Why going for CLOs? It's because you have floating rates, which is a great tool, especially because you have a higher remuneration than other type of debts. We'll show later some statistics about today, what is the spread, and it's still very high. It's super diversified. Typically, when I have 15 to 20 CLO bonds, I have 500 issuers underneath. To give you an idea of how diversified it is. You will never see a bond fund which has such a diversification in terms of exposure to one issuer. I think the maximum weight is around 1.5%. So it's very, very low. And the top 10 typically is less than 10%. You have a capital protection for first default, which I estimate is difficult because you have to make a stress test to many factors. But I estimate that from 16 to 28%, according to the level of rating, you are protected against default. Again, the highest level was around 10%. So you see that we are out of the money in terms of risk. Daily liquidity, which is, compared to private credit, I think is very cool. Higher remuneration, I will show you some statistics later. Lower fees on private credit. When you buy a CLO bond, you don't pay any fee. So it's a big advantage. And of course, it's liquid. What are the drawbacks? The drawbacks of CLOs, it's mark to market. So I'll repeat it again because I think it's important that everyone knows that it is not, it cannot be totally perfect. So it fluctuates with markets. Like high yield also is volatile. But it's actually an opportunity from time to time because you can get into a market at a price below par, and then you benefit from something called the convexity, so the return to par. So I don't think it's such a bad drawback for people who are buy and hold and can sustain some volatility, but it's not crazy in terms of volatility ever. It's limited to professional investors or qualified investors. That's important to know. And it has high capital charge if you're an institution, banks or insurance companies. That may change over time, but for the time being, Solvency II is pretty tough on insurance companies. They have 100% capital charge, which is one of the reasons. At the end of the day, I'm explaining you something which looks like a free lunch. And it's not a free lunch. It's the reason why it pays more than most bonds is because it's complex. It's perceived complex more than it's complex, but it is what it is. And people are very often confusing CDO and CLOs. And that helps, of course, yield to stay high. And also, it's a very limited audience because the large buyers, banks and insurance companies, are not in that market. So who is left is family offices, hedge funds and pension funds. So if you are a family office or a high net worth individual, it's a perfect match for you because you don't have the capital charge constraint and you can benefit from a high remuneration. Now, the future might be that the spread will further compress because rate cuts means, of course, the spread are going down also. And the fact that you start having some ETF, although the ETF are only on AAAs in Europe, but you can imagine that in 2 or 3 years' time, maybe you will have an ETF on mezzanine. And the fact there is actually a strong lobby for institutional to get access to the asset class because in the US, the market securitization is 10 times bigger than the European market for the same size of PNB. So there's something wrong. So there's a lobby right now at the European level to release the capital charge of a large institution. I don't think it will happen overnight, but it can take 2 to 3 years. Maybe in 2 years' time, insurance companies can buy CLOs. That will have an impact on the market. It will be more liquid, and also the spread will compress. Right? If you compress, if you're long these CLOs, you will benefit from it for sure, and because you will benefit from the spread duration, of course. So it's not a bad moment to position yourself into CLOs because they might become mainstream. I cannot guarantee it, but it's something could happen in the next 2 years. I think we can move to some statistics here. So 2023 was also an amazing year. You see, well, look at the double Bs, which is typically where I tend to position myself. 2023, 17% performance. You see that it's not only when you have inflation. You can see that even in reducing inflation markets, CLOs outperform anything else in fixed income. We can move one more slide. And yeah, that's kind of recap what I said. I think we can move to the. I'd like to show you also recovery rates. This is one thing I mentioned that because these loans are pledged, are asset pledged, they are protected by typically it can be a building, it can be a license. Also, they tend to have a higher recovery, and you can see it statistically. In average, recovery for loans is 64% versus 40% for bonds. So loans are rating higher on the balance sheet than the bonds. It's important to mention. We can move to the next one. I think it's interest coverage. I think it's a bit dated, this one, but today we're still around. It has gone down, but we're still around three times covered, which is pretty comfortable. We can move to the next one. Let's keep this one because I like to leave some time for the questions. I like to show the. We can move again. I like to show the relative value slide. So let's keep. I'll talk about the ESG after, but let's keep this one also. Yeah, so my track record as a manager, I think it might interest you. So this is only as a fund manager, but I am also a managed account manager. So I have statistics from 2019 on CLOs. I can tell you from 2020 to 2023, the outperformance versus investment grade was roughly 30% cumulated. But if you start from the time I started to manage funds is April 2023, you can see here the outperformance is more than 10 points above high yield after a year and a half, and much more versus investment grade. So the case for CLOs is still very good, and this is actually a real track from myself. But I have available also my track record from managed accounts, which starts from earlier. Then we can move on to relative value. Exactly. So that's a slide which I think is important, is that are we now overheated market for CLOs? That's the question, right? Is it time to buy them, or have we gone too far down the road in terms of spread compression? You can see on the left the difference, the extra remuneration of CLOs versus high yield. As you know, the CLOs is high yield, right? The same level of rating, so it's typically double B for the bonds, so it's even a bit better. For the loans, it's between B and double B. So we're talking about the same material. So in comparing high yield and CLOs, you can see we're still about 300 basis points above high yield in terms of spread, which is more or less the average. It is the average, so it's exactly the average. And you can see that it has gone in 2018 as compressed to 200. So we know there's still potential to go there. We can stay there, but it can also go lower. That's my main scenario, that spread will continue to compress towards 200. And then another interesting comparison is that you take the spread, so the number of times you overpaid versus high yield, and this is actually at also at market at average market at 2 times. So you still 2 times paid more in terms of spread versus high yield. So this is something I wanted to show you to reassure you that the CLOs has done very well over the last 3 years for sure, but they are still overpaying massively for similar ratings in the high yield market. So it's still a very interesting relative value versus the rest. We can come back to the ESG slide. I will conclude on the ESG one before. Perfect. So this fund is not at all an ESG objective fund, but it has ESG constraints. So it is not SFDR 8 or 9 because the level of data we have is not sufficient to actually carry get all the numbers that the SFDR 8 or 9 requires. So we decided to stay SFDR 6, but it doesn't mean that we are not ESG focused. So we are only investing with managers who are part of the PRI principle. So they're avoiding all the red flag industries. They are focusing on less carbon neutral, industries, etc. And usually they have an ESG team, an ESG leader, etc. So these managers are top 10 managers. They are very close to themselves, issue SFDR 8 CLOs. 3 of them already do so. But I cannot guarantee that all the CLOs will be SFDR 8. But the day they will be all SFDR 8, the fund will be SFDR 8. That's our objective. So we take ESG seriously, not only for conviction reason, but because ESG is your friend in terms of credit, especially the G. You will see that most disaster comes in the credit world comes from governance problems. So it's very important to have this parameter. Although it's not the objective of the fund. The objective of the fund is still to outperform the high yield market and to deliver a performance of base rate plus 6 to 8%. This is still the objective of the fund. I think I'm done explaining CLOs and the fund, and I'm very happy to take question. Maybe, I don't know if you want to talk, Pascal, about the fund terms.
Yeah, perfect. No, I think it was very clear. Thank you, Jean Marc. We already have a couple of questions in the queue. So if you want to ask a question, you can use the Q&A tab that you have in the Zoom application. Just before we move to the Q&A, I just want to give you a quick summary on the fund structure. So the name of the fund is Kapture CLO Income Fund. You can see here the key terms. I mean, I'm not going to repeat everything, but we will have share classes in euro, US dollar, and Swiss francs. Everything is going to be hedged, as Jean Marc said. The NAV is going to be weekly, so we have weekly liquidity and just a 5-day notice. The investment minimum is going to be 100,000 euros. You can also here see the fee structures, which is 125.10. And finally, the service provider in Luxembourg is Apex, which is a bit different to some of the other funds that we manage. So Apex is one of the biggest companies in terms of fund administration and custody and so on in Luxembourg. So you can see here Fundrock, Apex, European Depository Bank, it's all the same company. So they do basically the whole service for us, and it's very institutional. And the fund is going to be audited by PwC. Let me quickly check the questions now that we have received so far. I think one question is whether you're going to get the slides after the call. Yes, so there's going to be a replay. We're going to send the replay together with the whole presentation. Second question, I think it was already answered by Jean Marc. It was, how should we invest now in CLOs, in the Kapture CLO fund? I think Jean Marc presented it when we were talking about the spreads and the relative value.
I'd like to add the fact it's very difficult to time. We try to do that also for ourselves, right? It's very difficult to time the market. It's when people think the market is ahead of itself, and then it will further go down in terms of spread. So I think the only thing to do is to be invested and to be buy and hold, and to have a horizon of I think 3 years. I mean, I don't see how you can lose money over 12 months, to be honest, because through the history of CLOs, I didn't see a loss mark to market on a rolling 12-month window, but it can happen. But I'm pretty sure that if you hold it for 2 to 3 years, this is not possible. I think you will get your yield, right? Again, at the end of the day, these are bonds, so the return to par is mechanical. So I would say anybody who's ready to commit to 2 to 3 years, I think it's the right way to look at it.
So one of the questions that I would have is, I mean, you mentioned it, it's almost too good to be true because we have CLO 2.0. There has never been a default on debt tranches. You can see that even in the great financial crisis, would be covered easily with no loss. So the question, and you get weekly liquidity and 10% return. So my question is, I mean, what would need to happen to have losses, let's say for double B CLO tranches?
Yeah, I mean, if you want to see losses, you need, as I said, in double B, probably at least 25% default. 25% default versus 2% average default rate in the high yield market. It's never seen because the highest was, I would say, 10 to 12 if you want it to be large. So it's more than 2 times the worst case scenario. And you need that for a certain period of time. It's not if it happens for 1 quarter or two, it's not the end of the world. So if you make a loss on a single B, which of course has not occurred since CLO 2.0, then I think equities are probably worth 10% of today's value. That's one thing.
So down 90%. The Nasdaq minus
Yeah,
90% in this scenario.
that's more or less what the simulation says. So it's not, again, it's statistically not likely. And the thing you can have is, of course, serious mark to market. This fund can lose 10%, maybe 15% if we go through COVID again. That's something to know. But it's been a fantastic opportunity when in 2020, our total return has been 23% because we had the opportunity to buy these bonds below par. Whenever you buy a CLO below par, it's a big present because you have calls in this CLO. So from time to time, they are called. And so when they call you at par. And so if you can buy below par, you know that you have optionality. It's fantastic. I mean, I'm not hoping for a black swan, but I say that sometimes black swan are great opportunities.
So that's
So
interesting.
again, I don't think you can lose money with double Bs,
Yeah.
definitely. But the next crisis can be worse than the previous one, of course. And that's why I forgot to say the most important thing, that I'm actually making a very thorough selection of very conservative managers because our aim is to be protected for GFC times 2 or 3. We know it's not going to happen, but that's the job of the PM is to make sure we are good in all markets, not only when it's bull market. For the next year or so or two, it's going to be bull market for sure. But you never know. That could be another event in the market. The central banks usually are here to play. So we don't even see the GFC happening again. But you have to be prepared for something you have not seen. That's why we're focusing. Our manager focusing on our roughly 10 to 15 managers out of a universe of 75 in Europe, for example, to give you an idea of the selectivity. And we want managers who have very low risk portfolios. So they don't buy triple C's names, for example, to try to return them. They have an average rating which is higher than the market. Most of them have got zero defaults since they manage CLOs. This is really our philosophy, to feel very good that if there is something bad in the market, we can just stay invested and we don't have to worry. That's exactly our philosophy.
Sounds good. So I think it's a great product for financial intermediaries because you have strong returns with very low risk, and the risk that you have is extreme tail risk. And most of us, I mean, if something like this happens, I mean, you have probably other problems, so it wouldn't be your biggest worry in the portfolio. We have some questions about which tranches we focus on. I mean, we mentioned it a little bit, single B, double B. But there's also a question around, whether we know the percentages and the average yield that we have per tranche. Maybe you can elaborate a bit more on that, Jean Marc.
So the idea that this will not be static, but will be dynamic over time. But today, for example, the target is to be mostly in double Bs. and a little bit in triple Bs also, and a little bit in single Bs. I like to buy the triple Bs in the US. Don't ask me why, but because again, I still feel the US market is a bit more risky, not more, but not much more, but a little bit more risky than the European market. So typically, my triple Bs will come mostly from the US market, while my double Bs and my single Bs will come from the European market. Well, you can say that maybe 70% double Bs and the rest split in two, so 15 single Bs, 15 triple Bs. Probably my target today, but tomorrow I may say I want to be 50% in triple Bs because I'm paid well enough and I want liquidity, or each market is different, but today that will be the split.
And the yields, more or less.
And the yield's going to be around 9% today. With the split I mentioned, it's going to be about 9.5%. Sorry, in euros, so in euro terms. So
Yeah.
in dollar, it's +2. Yeah.
Yeah. Okay, there is some questions on the duration of the loans. So what is typically the duration of the loans and of the CLOs?
This is a good question because I forgot to mention that. But so the interest rate duration is 1 quarter because it's fixed at the beginning of the quarter. So it's 0.25. So there's virtually no sensitivity to interest rate. But the sensitivity to spread is linked more or less to the maturity. The maturity is 7 years, typically when you buy in primary. So you say in average is 6 years for the fund. But when you take into account the calls, the fact the issuer is very likely to call after 2 years, most of the primary. And so it depends if the call is in the money or not. So has issuer an interest to call or not? And when I do the analysis of actually my entire CLO position, I find out that my duration to spread is more like 3.5. So my sensitivity to spread is 3.5. So if spread goes up 100 basis points, I make 3.5% less. And if it goes down by 100 basis points, I make 3.5% more.
Okay, perfect. I mean, there is another question on the managers. Maybe you mentioned some examples, but do you have an idea of what type of CLO managers we select?
Yeah, sure. Well, I can give 3 names. Fair Oaks, because he's not super known as a CLO manager. They don't issue very often. I think they've done 5 CLOs only. They are very conservative. They issue, when they feel the market is very good. So that's one of the managers. Palmer Square, which is a US name, invest both in US and Europe. They tend to be very, very conservative also. I also mentioned White Star also, White Star is interesting because it's a PE firm also, but they buy 100% of their equity of CLO, which is also something I like because it's more than alignment, is that they are first loss where I am third loss in double B. So I really like this kind of managers when they keep the equity of the CLO because, of course, they are less aggressive. They're not marketing the subordinate tranche of CLO, so they don't need to make very big returns. So they tend to be safer. Yeah.
I mean, we have now 2 follow-up questions on the yield and the fund's target return. Just the mathematics behind it. If we get to a 9% yield, I mean, the question is whether it's yield to maturity, yield to worst, or just the current yield. You mentioned the 2% hedging benefit to US dollar, but how exactly do we get to the 10% net? I also guess that the 10% net, it's probably not something that is going to be achieved always. Some years are going to be better, some years are going to be worse.
Yeah.
But the idea is just to help a bit with the calculation, how we get to the 10% target.
Yeah. So this is a mix of different positions. To give an idea, last year, about CLOs with an expected yield to call, or yield to worst, if you want, of 17%, right? So how is that possible? Because the coupons is more like 10-ish%, right? And this is because these CLOs were worth 95 or 92. And when you do the maths, you have 1 year left before the call, and you do the calculation. If it's called at 100, including my coupons, floating rates at 4 points, etc., plus the fact it's called at par, you calculate a 17% error. So you will have situations at 17%, but not always, but from time to time. And you will have the classic ones, which is you get something which today is more like 9% yield. So that's one thing. So some special situation will add some value. Then you have the rolling down the curve effect, which means I'm buying a 6-year maturity CLO, right? But I am actually dynamically managing the position. So if I know it's going to be called in 1 year, suddenly my CLO is no longer 6 years maturity, it's 1 year. So it's going to get valuated at a lower spread. And so I'm going to sell it, let's say, at a spread of 2%, because now it's 2%. It's 2% plus base rate. And I'm going to buy another one at 6 or 7% spread. So, and by doing so, you create alpha, right? So if you combine all this effect, I think there's 1 point, let's call it alpha. I don't think it's great word, because alpha means I'm a king of creating a magician, but I'm not a magician. It's structural alpha, if you want. So something which you do systematically, and then you don't have to be super smart to do. It's just because you have the systems would tell you which bond is actually interesting. But let's call it alpha. So if I start from what I said before, 9% plus 1% alpha, we are 10%, plus 2 in dollar, 12%, minus fees, we end up at 10%. That's my rough calculation.
Makes sense. Makes sense. There is another question about it's probably within the CLOs. What happens if loans are called? Will the proceeds be reinvested or distributed in the next quarter?
Oh, yes. So it's very efficient. So the settlements are coincide on the same day. So when the CLO is refied or refinanced or reset, reset means not only you buy the debt, but you're going to reissue for another 6 years. Refi means you keep the bond as is, but you just recalculate, reoffer a new coupon, a lower coupon. In both cases, you have a priority to stay in the bond, right? So that's important. So you're not kicked out. And then the settlement will be exactly the same day. So there's no cash effect. Okay. Then, of course, I can decide to reinvest. So not to roll this one, but to buy another one. And that's very important in what I do is the cash management. It's a super intensive job, because you have to prepare not only for the cash, because you get cash flows in the fund at the end of the month or at the end of the week. So you have to prepare for cash flows coming in, and you have to buy in advance all the time, because in primary market, you have a settlement between 2 and 4 weeks. So this is a cash management we do, and we have a tool to do that. And it's very precise, it's very difficult, but our aim is to be 100% invested all the time. We can never get 100%, but I think in average we've been something like 98% invested, which is actually quite a good achievement. But yes, we're managing cash flows dynamically. But also more importantly is that most of the calls I sell before, because in a market like today where interest rates go down, spread are going to go down. So you're not paid to wait. So you better roll before the call. And so typically in my portfolio, I've rolled 30% of the portfolio last year, to give you an idea. So it's quite massive. Not every year is like that, but in a year where spread are going down, you better roll before. So instead of waiting for the manager to offer me the new bond, I sold it in the market. There's a lot of people who wants to get short-term paper for 6 months, because it pays more than anything you can find in corporates. So there's a market for people to buy for shorter period before the call, and they are very happy to have something short. So usually I sell it before, and it's also easier to manage a cash investment. But it's a good question.
Perfect. There is a follow-up question on the target returns. I can take it. So if the 10% is like the net target return for US dollars, it should be, of course, a bit less for euro and Swiss franc. I mean, of course, just interest rate differentials apply. So of course, this can change over time. But if we look at the current interest rate differential, of course, euro is going to be maybe 2% lower, and Swiss franc it's going to be about 4% lower versus US dollars. But of course, as I said, this is just the current situation. We don't know what's going to happen to interest rates in the future.
Well, you have to look also, I mean, it's right. I mean, like today is probably 8% in euros, but you have to look at the mark-to-market effect. If spread continue to go down, there will be probably 2 to 4% extra performance within 1 year, right? So this is mark to market. So it depends. People want to think mark to market or yield to maturity. Yield to maturity 8%, but in the next 12 months, I think it's more likely that you can make 10 to 12.
Okay, perfect. Another question is, how many CLOs are you anticipated to buy in the fund?
I think 40, around 40 bonds, right? From 15 different issuers, 15 different managers. That's more or less the target, yeah.
So this would basically mean that underlying loans would be more than 1,000, right?
Yeah, not really, because what happened is that, well, you can say 40 times 100, 4,000 even, but the fact that you have overlap between the
Overlap, yeah.
CLOs, and the biggest 10 names are almost in all CLOs, but you can play, for example, I managed to reduce the exposure to Altis in my portfolios to 1.2% by picking up some managers who don't have Altis. Then what happened is, because my managers are conservative, they actually trimmed Altis. So Altis is now 0.4% of all what I hold in CLOs. But yeah, so typically when you have 40 bonds, and at a certain point, there's no more diversification. So after 20 bonds, you don't get much more benefit. It's just you have to buy more bonds because the inflows come at different time. So you have, and your paper you bought in the past are not always available, so you have to buy new paper. But otherwise, I think 20 bonds will be enough. But just by the practicality of investing cash flows, different time you need 40 names. But you get 20 bonds or 40 bonds, you get around 500 issuers. That's probably the max you will get, not more than that. But the top 10 will be less than 9% of the fund, which is very attractive. So imagine that it's the 10 largest issuer in Europe, default at the same time, and even with zero recovery, you have a 9% hold, which means you still get all your coupons.
Yeah.
So it's a very compelling stress test, I would say.
I mean, here it's really a statistics game. At the end of the day, I mean, with 500 names, the diversification is extremely good. You can do the numbers, as you said, you know exactly what your subordination levels are, and you know exactly what the loss rates would need to be to start to lose. Of course, you
And
can
it's across many sectors. It's important because a crisis never comes on all the sectors, right? Or this will be 1929, but usually it comes from one sector.
Yeah.
You don't have real estate, which is one of the classic one. You don't have energy sector, which of course in 2016, 18 was tough. You don't have banks, which are dangerous animals, as you know. You don't have insurance companies, which might be in trouble. What's happening in the world? So only have really companies, and most very sound companies, which are real activity companies, not financial companies. So it's pretty robust.
Okay, perfect. We still have some questions, but I think we are running out of time. I guess that we will then address the question on a one-by-one basis. Also, if you have future questions, how to subscribe, where to find the fund, and so on, we can take this up on a one-by-one basis. Just contact one of the relationship managers within the whole organization, and we are happy to provide you more information. As I said at the beginning of the Q&A, this webinar is recorded. We're going to send it as soon as possible together with the presentation. And if you need anything else, myself, Jean Marc, and the whole sales team is going to be at your service. So with that, I want to thank Jean Marc for the interesting presentation. Highly appreciated.
With a pleasure.
Also, thanks to you all for the attendance today. And hopefully we see each other again with the next webinar that's probably going to be in around 1 month's time. Thank you so much.